All right, and welcome back to our live examples on position sizing. Once again, we went through the PowerPoint. We explained how to establish a position and never risk more than a certain percentage of your trading capital on individual trade. And all we want to do here is just go through a couple of examples of what we went through in the previous tutorial and show you how this would work in live market conditions. And we'll be using our little demo account here. And we'll go ahead and go through a scenario off a trade in our from our live trading class that we're still looking at. So this would be a good example to go through, is looking here at this Aussie US dollar. And I'll go ahead and pull this down. Essentially, as you get a little bit more focused on technicals, which we still have to go through quite a bit of technicals and trading. This is very simple. This is Aussie dollar to where we're looking to do a sell trade on a very simple pattern, a reversal pattern called a head and shoulders, where we got a left shoulder ahead, a right shoulder. This line right here is what we call a neckline, and we are looking to sell the Aussie dollar should it break down below this neckline, and we're looking for a little bit added confirmation on this to breach a psychological level, which is the 7,600 level right in through here. So we feel if it does that we may get some momentum to the downside on the Aussie and potentially have a good trade set up. So the sell entry on this trade, we want it to break through the 7,600 level. So let's just say that our sell entry, should we get in on this, we don't know what the price is going to be yet, but let's just kind of get a good idea of how many lots we can do on this trade. So we'll call the sell entry as 0.7595 on the Aussie dollar. Whenever we put in stop orders, essentially the best case scenario for us is going to be, people always ask, where do you put our stops? Well, we generally are going to put our stops where we're wrong. If we're looking for the Aussie dollar to go down, we're wrong if it goes up. And what price levels would it have to breach in order for us to consider this to be in an uptrend? Well, if it breaches this previous high, this shoulder over here, that would certainly be a level in which we'd want to be getting out. So if we put in our stop here above this high, 0.76, we'll call it, we're going to put it 1 pip above this high, so it'd be 0.76, and we'll just say 76390 or 7639 is where we'd be putting our stop order. So let's go ahead and we'll just write this out on our trading sheet here, on our position sizing sheet in this example, and we'll go through here. Pardon me for 1 second. It's always embarrassing when a phone rings during your tutorial, but we can make do. All right, so we're selling our sell entry on Aussie USD. We want to get in, we'll just call it 0.7595. Our stop is 0.7639. So how many pips are we risking on this trade? We got in at 75.95 and we were to get out at 76.39. We're going to be risking 44 pips. So with that being said, how many, and we have what, 11,275. So let's say how many standard lots could we trade? Well, let's go through the motions here. Our trading capital is $11,275. And let's say we are utilizing a 2% rule in our account. So we would take 2% of 11,275. And just so we get exact math here, I'll go ahead and use my handy dandy calculator. So $225.50 is the maximum risk I can put up on this trade for the total trade. To get to how many lots I can do, we have to figure out risk per lot. Now our stop order here is 44 pips. And we multiply that by the pip value on the pair that we're trading. Aussie dollar, the dollar is the quote currency. If we're trading standard lots, it's going to be $10 is going to be the pip value. So that's going to come to $440. And that's going to be our risk per lot. Now looking at this from a 2% standpoint, if we have a 44 pip stop and we're using $440 is going to be our risk per lot, what do you see here? This actually was done on purpose here. If we have $225.50 as our maximum risk on this trade, we had a 44 pip stop, which means we're risking $440. What do you see? How many lots can we do? We can't really do any because 225 divided by 440 is not going to give us enough as far as we're going to be risking way too much of our account in order to place this trade. So how this goes back to our lot sizes, how can we fix this situation? Well, in most Forex accounts, you don't have to trade standard lots. You can trade mini lots. There are quite a few people, though, that will open up $10,000 accounts, and instead of managing their risk, they'll go in and start doing standard lots on a trade. So what does this change? It doesn't really change anything from a trading capital standpoint or a 2% standpoint. What it will trade, it changes our risk per lot, because now instead of having $10 pip value, we only have a $1 pip value when we're trading mini lots. So in this case, that will take our risk down to $44 risk per lot. So now we're in business. Now we can figure out how many lots we can do. So we take the 225.50, we divide it by 44. And that comes to 5.125 mini lots. If we round down, it just means that we put in 5 mini lots. Now when we go into this trade, we know we're not risking more than 2% of our account. If we get stopped out, we're not going to be decimating the account. We're only going to be risking 2%. Now our new trading capital, if we were to go in and put in another trade, this is another thing that you need to do whenever you have open trades in your account. Our new trading capital, we would take 11,275. If you're doing a rolling, statement of your trading capital, you would take the 11,275 and you would subtract your total risk on this trade. In this case, if we're doing 5 lots times $44 per lot, we would subtract $220. So our new trading capital for further trades is going to be $11,055. So that's our new capital. And we can still use our 2% rule. We just have to figure how many, based on how many are open risk on our trade and our stops, we always have to figure in a worst case scenario. And that is, if we get stopped out here, we no longer have 11,275. We actually have much less than that. Now going through an example, if we were to take this new trading capital of a pair, let's say that will have a different pip value, we'll go through an example from yesterday on the dollar CAD. And I'll just make this one easier on you. On dollar CAD yesterday, and I can just write this out on the trading sheet. We wanted to sell dollar CAD, and we wanted to put in a 50 pip stop loss But let's say we were putting that trade in now. How many lots can we do? Off our new trading capital, we now have $11,055. So we would take 2% of that number. So that comes out to 0.02, 221.10 is our maximum risk on this trade. For risk per lot on this, we're just going to say mini lots once again, because we've already kind of established the fact that standard lots are definitely not a good idea as far as our risk capital. So our risk per lot on this, we would take our stop loss, 50 pips, times the pip value on $CAD. Now $CAD is a indirect rate transaction. So our pip value is not necessarily going to be like $1 on this. We would take lot size of 10,000 times tick size, 0.0001. If you remember this is based on our pip calculations, or our pip value calculations, and that comes to 1. And yes, you saw that right. I actually did do that on the calculator. I have no idea why, because that one was pretty easy. And then we would take $1 and divide it by the exchange rate, the opening exchange rate. In this case, the exchange rate, you can see it over here in black, is 1.29730. So that's the exchange rate on the pair. So I'm going to divide it by the exchange rate, the opening rate of our transaction, and that comes to 0.77. In this case, depending on which broker you're with, we have a 77-cent pip value. Some brokers may round this up or down, but 77 cents is our pip value on this trade. So our risk per lot, we would take the amount of our stop, 50 pips, times 77 cents on the pip value. So that's 50 times 0.77. And that's $38.50. And this is in US dollars, right? $38.50 risk per lot. You see, some people that assume what the pip values are in these different pairs, we do this as a class all the time, to where people might think a 50 pip stop is a large amount for a stop order on $Canadian, but our risk here in the US on these indirect transactions is actually much less, because we're not risking $1 per lot on mini lots. We're only risking 77 cents. So now all we got to do is divide it out. We would take the 221.10 divided by 38.50. And that comes to 5.74. So we could do 5 mini lots on $CAD. So we remain pretty consistent there based on where our stop orders are. But let's say we risk 2% on the Aussie dollar, okay? And then we figured that 2% into our trading capital, and then we went in, we did a second trade on $CAD, where we're risking another 2% of our adjusted trading capital. If both of these trades lose, which would be bad, we actually already won on the Canadian trade. We actually took that off the table this morning. If both of these trades lose out, I'm basically would lose a little bit less than 4% of my account. It would be much less than that. It would be more like 3.5%. Now, am I going to lose sleep over that? No, because tomorrow's a new trading day. I'm not going to go jump off a building or anything. This is such an important aspect of trading, and with the ability of managing risk in an account, just becoming a professional at that initially. And it's not a very hard thing to do. It just means that you have to be very disciplined and consistent in these calculations, which again, they're not very hard. These are this is initially what's going to help you in your Forex trading to be successful, because before you can even think about profits account, you have to think about your risk. I hope that was helpful to go through a live example there, utilizing an account. If you do have any questions, you can send me an email at education@NurreFX.com. But I hope that live trading example was helpful with calculating your position size. And I will see you in our next tutorial on money management. So thanks for coming in, and I'll see you in the next video.